Session 11.4, managing your tax. As discussed in session 5.4, there's two key issues with regards to tax on your property dealings. Identifying the taxes you'll have to pay and tax deductions you can make. Let's take them in turn, starting with taxes you'll have to pay. Stamp duty. Stamp duty is a mandatory state tax on all property acquisitions. When you purchase a property in any state in Australia, a percentage of the purchase price is paid to that state's government. This is known as stamp duty. It varies from state to state. You can click on the table to get your stamp duty in your state. In some states, stamp duty is payable within 30 days of contract going unconditional. So if you have a long-term contract, that is 60 days to 6 months, however, stamp duty might be payable prior to settlement, but in other states, it's payable at settlement. Land tax. Land tax is essentially a holding tax that we pay on investment property, and in some states on principal places of residence over a certain value. It represents a percentage per annum of the value of a land we're holding. Land tax was introduced many years ago to prevent people just sitting on vacant land and holding up development proceedings. The state governments at that stage established a tax to motivate land owners in emerging communities to either sell or develop. As the value of their properties rose, so did the land holding costs on a per annum basis. Unfortunately, today, land tax is pretty much a state government grab, and many people who own multiple properties find their land tax bill to be tens of thousands of dollars each year. You can acquire investment property in each state with a land content up to a specific threshold without attracting land tax in that state. Each year, the valuer general from each state government will have a valuation carried out on every block of land on an unimproved basis, that is, for its land-only basis. This is cited on your rates notice, known as your UCV, or unimproved capital value. You can query or object to these valuations. There's a table in your PDF that you can click on to study it in your state. GST, Goods and Services Tax. Now, I spoke about GST before and said two things, and I'm pretty much going to say the same two things. First of all, there's no GST on rental property, but there is GST on all your outlays that you pay. What I'm really going to say to you is, get yourself a good accountant and understand it. I will say on GST, however, if you are going to buy and sell property and specifically develop property, you certainly need to factor into account that when you're developing and building, you pay GST on your goods, and when you sell your apartments or land or whatever, you have to pay GST, that is 10% on the value of the land. Simple. Do your numbers, get a good accountant. Capital gains tax. Same as GST, get some accounting advice. But the simple answer, your own principal place of residence, the house that you live in, is not subject to capital gains tax. However, every other property purchased post-1985 is subject to capital gains tax. The capital gains tax is the difference between your purchase price and the sale price. However, it's reduced by 50%. So you get a concession if you've owned the property for more than 12 months. It's all in 7 steps to wealth. So by now you've got this book. Your issues on land tax and capital gains tax will all be answered here. But again, see an accountant. Ask them. Get to know this stuff. Not difficult. Tax deductions. There are two elements to tax deductions on property. Negative gearing, which allows you to claim as a tax deduction the negative difference between your outlays and your income on income-bearing property. This allows you to offset your costs and reduce your taxable income. Depreciation, which is a very useful cash flow tool. We talked about it a bit in session 5.4, but I'll repeat myself here with a few extra pointers. Reading exercise. Negative gearing is so integral to passive wealth building that it was discussed in detail in context. If you want to refresh your memory, refer back to session 5.4 or 7 Steps to Wealth, Step 3. Depreciation for cash flow. Depreciation is the hidden tool for managing your cash flow when you are buying investment property. Any property built after 1985 can be depreciated. That is, the whole of its value can be written off down to zero over 40 years. Many people depreciate their buildings based on 2.5% of the whole value over that 40 years. However, to get the maximum from your depreciation, use a quantity surveyor who can separate the total cost of your building into structure and then fixtures and fittings. Fixtures and fittings can be depreciated on an accelerated basis and therefore increase your depreciation claim for tax deduction from 2.5% per annum to as much to 5 to 10% per annum. There's a table you can click on to give you an example of the power of depreciation. Houses, old or new. Say you're looking at two homes right next door to each other, and both the same size block of land with the same size house. But one house is $500,000 and is new, and the other is 5 years old and it's $475,000. What would you buy? Well, most people would buy the old house because it's $25,000 cheaper. Wrong, wrong, wrong. Why? The bottom line is this. The new house, I've paid $500,000 for it. I can depreciate $250,000, which means I'm only paying $250,000 for my land. The old house, I paid $475,000, but my depreciation is only $197,000, which means I'm paying $278,000 for my land. Here, paying $250,000 for my land. Here, I'm paying $278,000 for the land. Remember, the houses, the buildings that sit on top of the land, it's all going to be depreciated. That's the takeaway. Depreciation is the secret in tax. It's the special sauce, certainly for cash flow, but also the best way for you to effectively buy land. Depreciation on commercial properties. From a cash flow perspective, the depreciation on commercial properties is also worth taking into consideration. Some commercial properties may have been depreciated by as much as 4% per annum, while others will have similar schedules to residential properties based on similar calculations and verifications by a quantity surveyor. Accelerated depreciation on commercial properties comes with fixtures and fittings, as in residential property, but also with plant and equipment, such as in air conditioning, lift wells, security systems, and on, which may have a short life. The most important point of depreciation in general is that it's only a strategy for tax deferment to enhance your cash flow, not tax avoidance. You can't properly ascertain its value until you get a quantity surveyor's report. Finding a quantity surveyor. To get a good quantity surveyor, contact the Australian Institute of Quantity Surveyors. You'll find details in the people work activity below. They can recommend someone who specialises in either residential or commercial depreciation schedules. Finding a good quantity surveyor pays off. People work. Click here for details on where to find a good quantity surveyor.